What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market, notably some monthly charts there. We've got our core list of companies that we're always watching, and this week I've got two additional trade ideas to share with you towards the end of the video, so definitely stay tuned for that. As always, anything we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. Kicking things off on the SPY monthly time frame, talking about candle structure and location as we always do. For structure, we certainly see a solid red-bodied bar, bears in full control, sellers stepping up at the highs and closing the monthly bar all the way down at the lows of the monthly range. And this is a clear shift from what we have been seeing over the past 3 months, right? If we look at this, big buy reaction at those lows, producing a nice lower wick. Same thing happens here as well as here. But for the month of April, you can clearly see the buyers were nowhere to be found. They did not step up at this area of support as they had done the prior 3 months. So bears do seem to be gaining some sort of momentum here. From a location standpoint, we clearly have a bar-to-bar lower high and a bar-to-bar lower low, and we're kind of sitting right at this area of support here. So I would be very mindful of this. We'll talk about it on the smaller time frames, but before we go there, I do want to just scrunch up the chart a little bit and provide some perspective. Maybe this is something that you might not hear too frequently, and this certainly doesn't mean that I'm flipping my stance to being bullish. Obviously, everything's pointing to lower right now, but if we just draw the fibs in from the low of the sickness up to the all-time highs, notice that we have not even come into our 38.2 retracement. Remember, if we were to pretend that this were a 5-minute time frame chart, what would you say about this move? Is this a reasonable pullback that's starting to unfold here? Absolutely, right? So as long as we're above the 38.2, I really don't think that there's too much cause for concern in the grand scheme of things. And to give you a dollar figure, that's going to be roughly 380 on the SPY itself. To tie in some macro and sort of economic thinking as well, right? Obviously, the Fed was very accommodative during this entire run with interest rates at zero, printing a lot of money, stimulating the economy. And now that's not the case as we're starting to get this pullback, right? So I wouldn't imagine that the market just wants to immediately rebound into something that looked like what we saw from 2020 into 2022, the early stages, literally right up here, right? So as the market sort of shifts, I'm just keeping these things in mind. But overall, just wanted to point out that we are still well above our 38.2. While we're on the topic of Fed, obviously on Wednesday, we will be seeing the Fed funds rate come out. Are we going to get that 0.5 increase that the market's kind of expecting, or will they shock us a little bit with a 0.75? We'll ultimately have to see, but be mindful of some volatility coming on Wednesday at 2 p.m. Eastern time, all right? Let's continue to drill down through the time frames. We'll remove that Fibonacci and work down to the weekly. What do we see from this perspective? So here's our round trip, that 100% retracement. Just, from a pure technical standpoint, it's very difficult usually for markets to get follow through from here. Now that the sellers have already done so much work to push prices for that 100% retracement, generally speaking, it's better to see some sort of dead cat bounce, lower high. And if we can put in an equal low reattempt to this general area of support off of the lower high here, that's the more attractive short to get some more serious follow through to the downside. Now, it doesn't mean that the market can't continue lower here, but I would say the odds would favor some sort of dead cat bounce around this area of support. We can also look at some other indications that a bounce could be underway early on in the week, but that would be more attractive, right? This is much more tradable to the downside instead of just chasing it and immediately shorting this thing on the open come Monday. So that's what I would say about the weekly location. And obviously from a structure perspective, upper wick indicating sellers stepped up at the highs, closed at weak dead on the lows, right? We don't need to beat that dead horse. And we're also starting to see an increase in the volume as this selling has been taking place. If we scrunch up the chart just to tie in pattern, because we brought this up in last week's video, here's your head and shoulders, here's your neckline. Remember that that is a moving target and we've closed right on it as of Friday of last week. Are we going to break it is of course the question to keep in mind. Again, I don't think that the market does something like this. If it does, I do imagine that we get a little bit of a snapback to the upside here to produce some sort of weekly hammer. But again, just keeping in mind, this neckline is probably what you want to focus on if you're going to shift a longer term focus to the downside and maybe get us to that 380, right? If this head and shoulders pans out, traditionally what we're looking for is the distance from the head to the neckline. So if we were to double that, again, this is just very, very rough here, that would take us to roughly 360. So again, longer term thoughts. I don't necessarily think obviously 360 is in play this upcoming week, but just sort of pointing out where the market could be headed based on this particular pattern. So overall on the weekly, yes, the short term outlook is lower, but do be mindful sitting right at support support here, 100% retracement, we could see a little bit of a dead cat bounce first. And then if we do produce the lower high equal low reattempt, as we pointed out, that's the more attractive short entry. Let's drill down to the daily time frame here and start talking about actual numbers, tradable levels, patterns, what's going on for this upcoming week. I know we're talking a lot about longer time frame stuff, but here we go. Here it is in the shorter time frame. So I would call this the start of a bear flag. It currently looks like we're breaking down out of that on the Friday session, but again, be mindful of this support that is the invasion day lows from, what was that, February 24th, I believe was the date. Nonetheless, that number is 410.65. Now, you are seeing something interesting on the screen that we haven't really talked about in prior weekly watch list videos, so let's just address that now. It's this gray bar here, and that's the weekly expected move. It comes from the trade tab. You can find this in your options grid. If you just go to the Friday expiration, which is right here, you can see the number, the expected move, is roughly $16.83. Doesn't mean that the market has to go there and stop. It doesn't mean the market can only go that far. It's just a rough guideline based on what the options market's pricing in. And I think it's interesting that the expected move is this area of resistance, this area of resistance, this area of prior support, and support from in here as well as the upper end. So to me, that's a very important pivot into this upcoming week at 428.75. As long as we remain underneath that, again, I'm sort of considering this bear flag consolidation, and that's really where we get the sideways move through time to correct the move down, right? That's where we cool off. And then again, if we just go sideways here, that does activate the possibility for a better breakdown to occur instead of just smashing through this immediately. It reminds me really of that NVDA chart that we've been looking at and talking about when we saw that 209 breakdown, right? So nonetheless, that's what we've got to the upside. Anything that remains underneath, again, 428.75 strikes me as bearish. I do have this intermediate level in here at 422.50. This is for you day traders, right? If we zoom in here, look at how well this level was respected all week. Monday, it's established as resistance. It's established as resistance again on Tuesday, Wednesday morning, Wednesday afternoon, Thursday morning. This is where that squeeze comes from. But notice on Friday, what's the low of the opening range? It's right on the number, 422.50. From there, we break down and see significant follow through. Okay, so I would count on that as acting as a significant pivot if we start to see any sort of upward retracement. So if you're a day trader, definitely have that level on your chart. But again, for you longer term thinkers, as long as we're kind of in this zone here, bear flag consolidation, eventually looking for breakdowns. If we just see a continuation move lower right out of the gates early next week, that's fine. Personally, I wouldn't really try to be chasing it short here, but nonetheless, I would be watching these levels down below as support. So 405 is coming from a prior double bottom. If I just grab 2 years here, we can show you these levels. So let's go ahead and zoom in on this section of the chart right here. So this is your double bottom at 405. This is an open and unfilled gap from 403.38 down to $400.67. And then the bottom level that we have is this prior resistance that sort of led to a breakout in here. And I sort of fudged it a little bit to align closer to our expected move range. So if I just, again, scrunch this up a little bit, you can see 395, 394 is roughly coinciding with that structure, and it's what the options market is pricing in for a downside move. So because we're moving into relatively uncharted territories, I would start to be pretty cautious around these areas here. Again, I do think that the market could be due for a little bit of a dead cat bounce and then a breakdown. The reason I say that, and I was talking about this not only from the round trip 100% retracement phenomenon, but also if we take a quick look at our S&P sectors, and we can walk through the sector ratio grid in just a second here, but notice how everything, regardless of whether or not you measured from yesterday's close or the day's open, it was down, and it was down significantly. Everything was down, 2% or more, with the exception of from today's open, the XLV for the healthcare sector down only 1.62%. Overall, I think if money's going to have to start rotating, that's where you get a little bit of a bounce, right? The nasty days are when everything is in sync to the downside, and generally speaking, these days don't happen back to back to back very, very frequently. We can also see this same phenomenon, I suppose. Let's hold off on the second sort of iteration of that. Let's quickly take a peek through these sector charts, and then I'll show you that, not to sort of string you along here. But nonetheless, materials here. Thank you, Jay, for correcting me. This is not builders, although it's the XLB, it's materials. I usually just say it the opposite way. Nonetheless, lightweight sector, not overly concerned, kind of in the midpoint of this overall range. Doesn't really strike me as a big deal. Energy breaking down, right? We talked about the failed sort of move outside of this breakout point here. Now that it's just cooling off in there, fantastic. That's great. We do not want to see this leading any charges to the upside. As long as it wants to play nicely kind of underneath that 78.50 now, fantastic, not a huge threat to the S&P 500. Next up, XLV for healthcare, right? This one is kind of a big deal because we are now underneath. We've closed underneath this double bottom neckline. So this does strike me as a bearish indication for the S&P overall. It looked like we were trying to resolve it in here. Obviously, giving it up is a bearish indication. It means there's quite some ways to fall until we hit that next sort of pivot around 127.50. So again, bearish indication for the S&P. Let's continue along. Industrials, again, not really a huge portion of the S&P 500, but at risk of moving to this low. Any downward pressure is downward pressure for the S&P, and it looks like it could be headed there at minimum. Overall, not the biggest drag, but something to be mindful of. XLP for consumer staples. This is definitely one to keep your eye on, noting that we're breaking down from a head and shoulders pattern that would look like this. Here's that neckline, very well-defined area of support around 78.23, bearish close on Friday underneath. Looking for some follow-through, I would start to expect somewhere in here, maybe closer to that 76 level. That, of course, will be a drag for the S&P, but overall, noting that this is a risk-off sector, it could potentially mean that if money does need to rotate somewhere, it will be freed up into a more risk-on sector, maybe the XLK. We'll see. I'm not saying that will happen, but this pulling back does strike me as a healthy thing if the S&P 500 is going to find a more meaningful bottom. I've been talking about that theme till I'm blue in the face for the past couple of weeks. Nonetheless, continuing along, utilities falling out of bed completely here. Does it find support in the prior flag consolidation? I would hope so. This has pulled back far enough off the highs where we do want to start to see it going sideways, not necessarily continuing this rapid descent all the way back down towards the lows. If it does want to move towards 65, that again is, just almost too much downward pressure on the S&P 500. Sure, we don't want it leading the charge, but we also don't want to see an all-out breakdown in utilities, right? Next up, we have communications, obviously, with Facebook sort of pulling back and Netflix really pressuring this to the downside anyways. It's just kind of neutral here. It's still far underneath this big flush point. Doesn't really strike me as the most bullish-looking chart. We don't really have any indications of a reversal. So again, it falls into the bear camp here. To be bullish on this one, I would need to see some sort of higher low produce, something that does this clearly, or if it just wants to start screaming to the upside, we would have to recapture this level right here. Does it look likely based on the structure we have? Not really, right? So falling into the bear camp. Financials, again, bear camp here. Everything's falling into the bear camp, right? You can see we are underneath this area of prior support, 35.50. Really solid red close underneath on the Friday session. Where could we potentially catch ourselves for next support here in financials? We have to go out, again, I believe it's a 3-year chart. We can see it. Could have got it with 2, but nonetheless, 33 is the next area of support in financials. Again, big pressure on the S&P 500. So not really a good look here for any sorts of reversals, okay? Let's continue along. XLK, heaviest weighted sector. This one's kind of the only saving grace about this is that it's sitting right on support. Now, don't get me wrong. This is clearly turning into a flush point, right? We did see that 100% retracement. Here's your dead cat bounce. There's the equal low reattempt. It's a flush point, no doubt about it. But if this does hold this support, if we take out this area on the chart around 146.60, that would be the heads up indication to me at least that, hey, maybe don't push your luck to the downside in the S&P 500. Again, does it look likely? Not really with the close week on Friday, but if we can take out 146.60, maybe you just set an alert there, you would say, okay, I'm probably not going to push my luck again in the downside camp for the SPY itself. If it does break down, that's fine. Go with it, obviously, if we never take that out. And you're looking for 136 as next support in the XLK. Underneath that, what do we have? It's been a while since we looked left in the tech sector. So I would say we're probably headed back down again towards that double bottom, 131.25. So again, plenty of room to fall if this ultimately does see some follow through underneath that 142-ish area of support, which, as we just qualified, was certainly a flush point. Let's continue along. Real estate falling back down out of bed. So here was that range we wanted to see it stay in. It was, looking good for something that did this. Falling out of that, again, more downward pressure for the SPY. We wanted to see these things cool off. We did not want to see them all out collapse and head back down towards these lows. So again, fairly concerning look here inside of real estate. Last but not least, the XLY for consumer discretionary. Obviously, Amazon absolutely hammered on earnings there on Friday. It's at the bottom end of the range. We talked about the sort of lag that it was experiencing in here, the fact that it had room to fall. Well, we're home again. So we have seen that 100% retracement, dead cat first, then an equal low does become more attractive for downside. So again, if this starts to bounce for that dead cat, maybe that's just enough upward pressure to at least keep the SPY sideways into the upcoming sort of week, right? So things to be thinking about from a sector perspective. Let's go ahead and take a quick glance at the sector ratio charts. Then I'll give you that second sort of idea on why we might see a dead cat bounce early on in the week. So the XLK clearly starting to perk up, one of the big four. It just means that it's been down less than what we've seen in the SPY. It's still down as we know, but from a relative strength perspective, it's starting to perk up. Obviously, we want to see if we can get it up and over that declining 50 SMA here, but it steps in the right direction. XLV cooling off sideways, that's A-OK. This is not what we wanted to see. Obviously, XLY getting weaker. We wanted to see this kind of resolve this sideways activity here to the upside, and it's currently not doing that. Financials as well, it started to have a positive look with those higher lows. That has currently stopped, and now we're getting much more of a sideways look in that ratio. So not the end of the world, but as we saw in the actual structure chart, the candle chart, it's not a good look, right? It's not a good look. So I would say that the big four are not really sort of indicating any sort of turnaround in the SPY itself or any sort of relative strength coming back into this market. And if we look at the bottom four, which we know are the risk off sort of sectors, they all continue to look fantastic. Even with the breakdown in the XLP, notice it's still relatively strong to the S&P itself. Energy still pointing higher, clearly. Real estate coming back in a little bit, but look at how far it is above that upward sloping 50 SMA, and the XLU for utilities hanging out sideways as well. So still, from a sector perspective, kind of in risk off mode. Let's go ahead and take a look at our internals here, and this is sort of that last indication I wanted to point out as to why we might see a little bit of a dead cat bounce early on in the week. Remember, we talked about this in the midweek market update. It's pretty rare that your advanced decliners hang out underneath that negative 2,000 mark, right? We saw that here, and that's exactly how we closed on Friday, underneath negative 2,000. Generally speaking, that's almost too much correlation for it to be a sustainable type of move. And again, if there's any sort of rotation between the sectors, it usually means that there's some sort of perk higher. So notice what happens here. We close really weak underneath. The next day, there's some money rotating back into some things, and that's where we did see the bounces in our S&P 500 itself. So be mindful of that. That's really kind of the only thing I wanted to talk about from the internals perspective. Obviously, massive outflows in volume on the Friday session, breaching that 300 million mark that we use as a benchmark, clearly to the downside, making a move almost twice that, closer to 600 million. And the tick, if we just take a look at the distributions throughout the course of the week, pretty flat as all of those bounces were happening, even with the squeeze on Thursday. Sure, it got positive, but it doesn't really hold a candlestick, a candle, I suppose would be the word, right? To this big downside build we saw on Friday. So nonetheless, internals just kind of confirming this downward activity. But this is my concern for the dead cat bounce early on in this upcoming week. So enough of the S&P 500, I suppose. Just to be incredibly thorough, let's take a look at the VIX. Why not, right? We've spent so much time, we may as well just do it all. What do we see in the VIX? Interesting thing here is that this has not actually perked up and made a new high, even though the S&P's actually made a new low, right? So if we just take a quick peek back and forth over on the SPY. Notice how we did make a new low there on Friday, and back on over to the VIX. We did not make a new high in the VIX itself. So does this mean that, we're kind of at that peak in terms of fear and what the market's expecting, maybe based on what the Fed has to say and where we are from a location standpoint? Maybe, right? Maybe. Other than that, I wouldn't read into it too much. Again, I would just expect volatility to increase on the Wednesday session as we see Jerome Powell on the mic for his FOMC meeting minutes, Fed funds rate, as well as the press conference afterwards. So that's it. Let's move along. QQQ is up next, obviously. We're going to go out to the monthly. We'll spend a lot less time on these charts, but nonetheless, it is important to look at them. Notice how the QQQ made a new lower low, closed underneath the two hammer lows there. This one, if we take out the Fibonacci's, from the low all the way on up to the high, you'll notice is at your 38.2. So this is in jeopardy of losing, quote unquote, picture perfect bull flag consolidation or healthy pullback sort of areas. So be mindful of that in your cues. That level is roughly where we've closed at for 315, right? But clearly, structurally speaking, this look is bearish, right? There's no doubt about it. Same sort of idea with the lower wicks no longer being there on the monthly time frame. Drilling down to the weekly, what do we see here? 100% retracement and some, making that move underneath here. Again, I do think that it's probably going to be difficult for this to see massive continuation to say something like 300, so like 15 points of continuation. Could it dribble a little bit lower and then snap back? Maybe. So I would be mindful of that same sort of ideas and thinking as to what we just discussed in the S&P 500. Here's your head and shoulders. Clearly, your neckline is kind of way out of whack. If you wanted to draw it in that way, that's technically how you would do it. Does that break in the upcoming week? Maybe. Again, some serious selling activity taking place from a volume perspective. If we scrunch up the chart and look for horizontal areas, this strikes me as important. We'll see that on the daily time frame in just a second, but 300 is also a nice psychological level of prior resistance resistance, which then turned to support on the weekly time frame. So that's a big one to be watching out for here in the QQQ. Let's drill down to that daily, start talking about tradable levels as always. Of course, we have our expected move in gray once again. So let me adjust that to the forefront. If I do something like this, you can see, again, very similar. The upper end of the expected move is right in line with that prior resistance that we saw earlier on in the week. That number happens to be 329.50 in the QQQ. To the downside, that expected move takes us to 297.50 down here, which is roughly aligned with that 300 that we just saw from a weekly pivot perspective as well. This 311.17 is coming from, if we scrunch up the chart, well, it looks like we'll have to grab that 2-year. So here we go. That is coming from this area of chop in there. If I just zoom in on that, the reason we picked this is clearly resistance, support, resistance, support, I mean, so on and so forth. You get the gist. Look at how well this was respected here. It was even resistance in those 3 days of balance that we saw underneath the level. So to me, 311.17 does hold some significance early on in the week. If we're going to start to see any breakdowns, things that do this and consolidate, then break that could be a potential short scalp for intraday trading. Again, would I push it, chasing it short from a swing trade perspective here? Not really, just based on that 100% retracement and what we just discussed in the internals and things pointing to the potential for an early morning or early week dead cat bounce. Quickly taking a look at that intraday pivot as well, just because it's so well defined, guys. 322.50 here in your QQQ. I believe SPY was the 422.50. Kind of interesting how that worked out. But nonetheless, support, resistance, 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 resistance. Again, look at the Friday morning session. That's your morning low. As we retrace all of that move, no acceptance above, boom, that's where your stronger selling comes from. So use that definitely for short-term trades. If we come back up into it, I would imagine that something like this could be a likely scenario for a lower high, resist there, looking for shorts on the back test of that important number. So that's what we've got in the QQQ. Back on over to the daily time frame here. We talked about upside, we talked about downside. Again, if we remain here, then it still just strikes me as bear flag consolidation overall on the daily time frame chart. Last but not least, IWM, small caps, Russell 2000. What's going on here? I suppose let's just do it. We'll go top down from the monthly. Bearish look. Here's your balance. We've closed underneath that. The next look from the monthly would be to here, 170, also the monthly 50 SMA. If we stay congruent and take out the Fibonacci's from the low all the way up to the high, notice that we are breaking down underneath your 38.2. So that is a fairly concerning look as well. Noting, again, just like the QQQ, this falls more into the camp of not holding up for picture perfect ideal consolidation. Let's continue on down to the weekly time frame, see what we have going on here. This one did not have as clean as a 100% retracement, right? It was kind of sloppy on the way higher. We knew that. It was stuck in a range. So breaking down from this range, I would say if anything's going to go and see follow through, IWM might be the one, right? So IWM does have potential here for a more significant move to the downside based on structure, based on location. Everything does point to the bear camp, volume increasing as well as we saw this weekly close outside of the balance. Down to the daily, let's pop those levels on, talk about the expected move here. A back test of this is the upper end at 193.50. That to me strikes me as a decent short entry for something that would do this. It would keep the lower highs clearly in effect, and it would keep the trend going lower. So look for shorts up against that area and then follow through back down towards these lows. 188 is your intraday. Really, really sloppy. Actually, I suppose I might not have just adjusted that. I apologize. Your intraday would have been right here. Okay, so that's 189.50. That's the level I would carry forward, not so much this 188. My apologies for not having that set up, but nonetheless, you can see clear shelf of support, flushes, now it's resistance, same exact thing that we just discussed. There's your Friday flush as well for the more significant selling to come in. So that's what we've got on the intraday for that pivot point. Downside, as we pointed out, based on the expected move, that's going to help us out as we move into sort of these uncharted territories. We saw on the monthly that 170 could be in play. It seems like a bit of a stretch based on what the options market's pricing in. Instead, we're currently looking at 176.50, 177 could be very likely. 180.75 is coming from. This one might require as well the 2-year outlook. So let's grab that. Here we go. There you go. So what do we have? 180.75. That's what it was. Coming from right around in here. And we covered this in the midweek market update, right? That's going to be from a break and retest level in the past. This 164 is a really old level, but a prior breakout level as well. I don't really think that that's in play, obviously, into the upcoming week. So that's a pretty decent look at our entire broad market. Hopefully it wasn't too long. Let me know, guys, by the way. Some of these videos have been getting longer and longer, closer to that 35, 40-ish minute mark. Do you prefer a longer in-depth video like this, or would you prefer a shorter, maybe 15 to 20 minute video that's a little bit faster paced. Maybe we don't dive into as much detail. Let me know in the comments. I would certainly love to hear from you. I don't want to bore you, but I do think at such a critical juncture in the market, it's kind of worth taking a look at all of these intricacies. So nonetheless, enough rambling. That just made the video even longer. Let's get into the core list. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. Kicking off our companies here with Apple. What an absolute sloppy chart here. The volatility is absolutely off the charts, no pun intended. Day up, day down, day up, day up, day down. Massive volatility here with some pretty significant ranges being traveled. Obviously, earnings are in the rearview mirror. What I would point out here is that we are not at these lows, right? 152.20 is the equivalent of that round trip that we were just talking about in the SPY and the broad market as a whole. So let's see, does Apple ultimately produce a higher low somewhere in here and then come back up for a trendline retest, or are we just going to come full circle and go into 152.20? Based on what the broad market looks like, I would say that there's some room to move lower here and sort of break down out of this nasty, nasty range that we've been trading in. Don't get me wrong, it's great for day trades and, quick scalps. Obviously, the ranges travel really fast, but in terms of getting follow through from a move, like a multi-day move that just trends one direction or another, it's just not the current market environment for that. So I'd be very mindful of any type of swing trades that you try to put on in basically any of the companies that we're about to look at here. So nonetheless, downside, looking for 152.20. From there, look for support and a dead cat bounce. To the upside, really nothing looks very convincing in Apple until we can break the resistance trend line, to be quite frank with you. Sure, again, day trades are fine back and forth, but for a more sustained long trade to pan out and more of a trend move to develop, it's got to break the trend line, right? So we're going to keep it pretty simple because, again, we did spend quite a bit of time on our broad market. Netflix, again, strikes me as just an absolute failure of a move. The reason I say that is because on Thursday, we printed the first green bar. So at least I was expecting, if we took out the high of that green bar, a little bit more of a squeeze to unfold. Again, a squeeze, very mild, just added buying pressure to come into the flush point at 210, right? It simply didn't happen. There was no follow through on the Friday session. Obviously, as we take out that high, sellers didn't really feel inclined to cover. There was no squeeze. So to me, it just looks like it wants to continue to sink lower. Downside target's going to be around 165 on any back test of 210. Again, I would look to go or find some sort of short setup there. If it breaks through it and then forms a higher low above, that certainly starts to shift the tone. The next good long setup is the squeeze over the 2-day highs around 228.13. Again, does it look likely to be in play this upcoming week? Not really. Tesla's up next. What do we see here? Elon Musk, the madman, finally stopping the sale of his shares. I suppose he's done what he's needed to do to acquire Twitter. Nonetheless, again, just like Apple, really, really volatile range in here. Not a whole lot of structure to be playing off of. This would be a pivot that I carry forward, roughly 873.50, just because we have so many data points stacked at that area. But notice this, and this is something that we've talked about on the channel in the past. Whenever you have two back-to-back candles that are opposing with tails, just treat it as one indecision candle, right? If we do something like this, technically we have a large upper wick, technically we have a large lower wick. That is screaming indecisive activity. Buyers aren't sure if they're going to scream it back higher. Sellers aren't sure if they're going to take it back down towards the lows, right? The upper wick and lower wick are conflicting. So I would say day trades in here, fine on the long side above that kind of pivot, right? And more attractive to the short side if we start breaking down underneath. And in that case, we are looking for the full move into 800 prior shelf of support from here and in here, right? After that, yeah, it could get more nasty, closer to 750 and 6, or maybe that's just 700. Those would be levels to watch out for after. But again, just as we're stuck in this kind of no man's land, nasty range with opposing wicks, I would just be careful, kind of stick to day trades only for better long setups. You got to clear 945 back to the upside from big prior resistance in there, right? And even after that, you do have to contend with the big flush point here around 978.50. So, longs even aren't looking fantastic here. If you've got a longer outlook on Tesla, I wouldn't call you crazy for starting to pick up some shares down here. Just nibbling on a little bit of a position, maybe it rotates back up higher. If you think about this as a range-bound sort of move that's been unfolding here, it's been lower, it's been higher, lower, higher, lower, higher. Maybe it's going to do something like that over the course of time. Just a thought. Again, it's not really that critical for day trading upcoming, but Tesla does seem to be stuck more range-bound instead of trending cleanly in one direction or another. Next up, AMD. What do we have in AMD? Clear balance in play. This to me looks like a much more attractive short setup than some of the other things that would be, quote, in my book, at least, quote unquote, chasing. Notice how we have equal lows stacked. We're kind of respecting this balance area right here. Breakdowns of 84.60 get interesting. We're looking for follow through into 73 roughly. Do keep in mind earnings are around the corner, so just be mindful of that, especially if you're trading options. For better longs, it's got to be a higher low up and over 92.50. Again, with the nasty inverted hammer on Friday's session, doesn't strike me as a likely outcome that we're going to do something like this immediately in the upcoming early parts of the week. So looking for shorts underneath this level here, essentially. Next up, Facebook. What's going on here? Again, they reported earnings, opened on the gap up, sort of didn't really hold it, right? Again, not really. Sorry, earnings were here. Duh, I'm talking about Friday. It didn't really get any follow through up and over that 210. Right? So to me, maybe it comes back down and revisits the top of the gap. Ultimately, the question here is, does this gap hold, right? So the important thing would be, if this gap holds, then fantastic. Continue to have the long, or maybe not continue, but shift your bias to long here, looking for follow through back up towards these highs instead of all out collapse, right? If we do something like this and then work back higher, clearly a bullish indication, noting that there's fairly thin structure, virtually no structure here. The sellers should have had no issue filling that gap. Notice how the buyers really responded there and pushed prices higher. So really use that top of gap 193 as your over or under level here inside of Facebook. Obviously breaking that and breaching to the downside, you're looking for the gap fill trade. There's plenty of meat on the bone here to trade for, so definitely something to watch for. If the entire market's sort of on the downward descent, that would be an attractive setup here in Facebook. Just like AMD, like Facebook, AMD strike me as early week watchers. Apple, Netflix, and Tesla kind of too sloppy, right? No clear setups there as of right now. NVIDIA, what's going on here? More similar to your AMD chart. There's your flush point. We have a considerable period of balance here, looking for breakdowns and follow through to the downside. Next support is 155.50. We searched for that in the past. The only long setup here is a break from the balance to the upside, and you're really not pushing your luck. You're just looking for the back test of 209. If you are, not short NVIDIA and you're more of a swing trade style trader, that's fine. If we do get the bullish move to here, you're probably looking for short entries, right, on the back test here. So be on the lookout for any inverted hammers that print, indecision dojis, basically any signs that the buyers are out of steam. It was only just a quick, squeeze to the upside. It wasn't really a sustained buyable move. If it coincides with the resistance trend line at the same time, fantastic, super resistance, right? So to me, anything that does this, looking for rollover back down towards the lows and breakdowns here. If you're really quick draw McGee, right, that's what we like to say, and want to try to capture that long move right here, that's absolutely fine, but don't overstay your welcome on the long side is what I would say about that. Next up, we have Microsoft Softy. What's going on here? Really nasty engulfer, basically an engulfer on the Friday session, unlike what we saw in maybe Facebook, where we kind of hung out in the mid-range of the Thursday session. You can clearly see new significant lower low back down underneath this pivot point here at the 278.50. To me, it looks likely that we at least come back down into the earnings low, prior low from here and here as well at 271. So look short first inside of Microsoft. Also, seemed to have relative strength after earnings on the gap up the following day and really moving towards those highs around 291. The big upper wick there, as we discussed in the midweek market update, was fairly concerning. So the fact that we were not able to get and interact with this gap overhead just is telling me again that the buyers are not really that impressive here inside of Microsoft. And again, I would probably look for shorts first before looking for any sort of reversals back to the long side. The best long trade would be breaking for this gap here and then moving through this range there. All right, currently doesn't look to be in play early on in the week. Next, and lastly, Amazon, the beast, but only for so much longer, right? January 6th, or excuse me, not January. Wow, it's late. June 6th, it will be splitting, right? So keeping this chart very, very simple. Obviously, upside, you're looking for this gap to fill if we can take out Friday's high. It doesn't look likely based on the pretty weak close that we saw on Friday. Any consolidation that happens here strikes me as bear flag. Again, if we can build out something similar to what we saw in NVIDIA around that 209, just to illustrate that once again, here's your round trip. There's the sideways consolidation that it requires to resolve for more follow through. That would strike me as more attractive for something in Amazon, right? So something that does this and then turns that into a flush point, that gets attractive. Wouldn't chase it short here. If it does start to break down, our next support is at 22.55. So be mindful of that. We talked about the long setup, but doesn't really look likely based on what we have in front of us here. So that's the core list of companies. Let's just jump right into these two trade ideas. I'm not even going to use the transition, and we'll just try to wrap the video up sooner rather than later. So Snapchat. 100% retracement, yes, but inverted hammer on the small dead cat bounce that we've been seeing here. Technically, there is some gap that remains unfilled to the high of that last earnings, not this earnings, but the prior earnings cycle. Inverted hammer, that gap has been filled. What I was getting at is if we come down here and flush the 2-day lows, you can tell it's late. If you're late and you're watching this on Sunday night, you know the keyword to drop. Anyways, we're looking for follow through into the low of that earnings candle. Okay, so underneath 26.50, shorts down towards 24.32. I like what I'm seeing here with the dead cat being rejected with the inverted hammer. Again, it's gone full circle, yes, but we have seen the dead cat clear lower high. We know that the trend is our friend if we do something like this. It's been kind of in a nasty downtrend for quite some time. Strikes me as being the path of least resistance. And last but not least, we have Snowflake. What's going on in Snowflake? Here is a considerable balance, right? Kind of like that NVIDIA chart we just saw. To me, it looks likely that this wants to break down. Based on the engulfer that we saw on Friday, this is a true engulfer with a higher high and a lower low from the Thursday session. It strikes me that, again, the sellers are taking control here. The buyers had nothing going on as we started to squeeze up and out of this balance area here. Again, buyers were nowhere to be found. They could not sustain the move. To me, it looks like lower is more likely than higher. So first target is, of course, the 2-day lows. But if that breaks, again, you're looking for just more serious continuation. Underneath 164.30 should get us to, if we just expand here, let's search for a target. I believe this actually might be new all-time lows. To be quite frank with you, obviously this was a newer IPO. Yeah, new all-time lows underneath 164.30. So you're just trailing a stop lower as we potentially continue to descend into the abyss. That's going to wrap up the video. It was a long one. Again, let me know in the comments section if you like the in-depth analysis where we do spend, between 25, 30, 35 minutes together, or if you'd prefer something a little bit shorter, we can certainly tailor the content to look something like that. Nonetheless, go get some sleep, enjoy some food, and I wish you all a green trading week.